I think that an exposure to emerging markets probably ought to have a core and satellite structure to it. And what I mean by that is the following, that I think one should begin with a broad-based index fund. Something like, I like the Vanguard one, some people like the MSCI, either one would be fine. It's broad-based, it's low expense, and both of them have done very, very well relative to active emerging market funds. So I think that's the way to begin. But then I think that it is perfectly fine to add to that the kind of fund that is designed to capture the kind of growth that we're likely to see in emerging markets. And by that I mean the following, that what's happening in emerging markets and their growth is that hundreds of millions of people are being lifted out of poverty and are becoming middle-class consumers. And the story for the future is this new world middle class who will be consuming and who will be doing a lot of this actually online. So that something like an EMQQ, which I think captures both of these characteristics of the growth, namely that it is technology oriented, it is right in the heart of internet commerce, and that it captures the growth of the consumer and the consumer's ability to increase his or her consumption as those consumers have over the past decades. So I would then go and put an ETF like EMQQ. It's active in the sense that it is targeted at a certain set of companies, but it also has the advantage that I like of being passive in the sense that it doesn't try to pick this stock over another stock. It doesn't try to buy Baidu rather than Alibaba and go back and forth between securities. So that to me is the way that I think people should invest, and I do it myself. I have grandchildren ages 9, 11, and 13, and they have a broad-based Vanguard emerging market ETF and EMQQ.